Welcome to The Explainer. Today, we're digging into the work of one of the greatest investment minds ever to figure out one simple thing. What's the real difference between a smart investor and a gambler? So before we get into any of the details, you've got to ask yourself this one fundamental question. It's the one that the legendary investor Benjamin Graham said is the starting point for everything. Are you really an investor, or are you actually just speculating? Because your answer to that question is, and this is no exaggeration, going to determine your entire financial future. So in this explainer, we're going to map out the exact strategy Graham created for what he called the enterprising investor. That's someone who's not okay with just getting average returns, someone who's willing to put in the work to really beat the market. Okay, so if we're going to follow Graham's path, first things first, we have to clear away the biggest, most dangerous obstacle out there. A myth so powerful it wrecks countless investors, and that's the belief that you can somehow time the market. You know that dream, right? The idea that you can perfectly time it, buy at the absolute bottom, sell at the absolute top. It seems so simple, it's incredibly tempting, but history shows us it's just a graveyard of failed predictions, even from the smartest people in the room. I mean, just look at this quote. Sounds pretty confident, right? That came from Alan Greenspan right before he became the chairman of the Federal Reserve. The only problem? He was spectacularly, disastrously wrong. The market was literally on the verge of one of its worst crashes since the Great Depression. And look, this isn't just one guy getting it wrong. As you can see from this chart, study after study proves it. Even the professionals, the ones who literally get paid to time the market, consistently fail to beat a simple, boring index fund. The evidence is just crystal clear. Trying to time the market is a loser's game. All right, so if trying to guess the market's next move is a trap, what's the next big mistake people make? Oh, it's chasing after those super hot growth stocks. You know, the companies that everyone is talking about. Just think back to the dot-com bubble in the late 90s. Companies like these were the absolute darlings of Wall Street. Their stock returns were insane, just astronomical. But take a look at that column on the far right, the PE ratio. That's the price you're paying for $1 of a company's actual earnings. Those numbers were just exploding, which means people were paying absurd prices based on pure hype about the future. And that's the trap right there. All that excitement makes you overpay. When a stock's price, which you see in that crazy high PE ratio, gets completely disconnected from its actual business profits, you're not investing. You're just gambling on a fantasy. And well, here's what happens when the party's over. When that hype bubble finally popped, these same amazing high-flying stocks came crashing right back down to earth, destroying fortunes and wiping out every penny of those earlier gains. This quote right here just sums it all up. Honestly, if you only remember one thing from this whole explainer, please let it be this. A great company is not a great investment if you pay too much for it. Okay, so we've talked a lot about what not to do. We don't time the market, and we don't chase hype. So what do we do? Well, Graham's playbook for the enterprising investor gives us 3 very specific places to hunt for real value. The common theme that connects all 3 of these strategies is pretty simple. You have to look for value where nobody else is looking. This might mean buying big, solid companies that are just temporarily unpopular, or it could mean finding profits in complex corporate stuff like mergers, or, and this is what we're going to focus on, finding what Graham called true bargain issues. Now, for Graham, a bargain is not some vague feeling or hot tip from your buddy. No, it's a specific, measurable thing based on cold, hard analysis of the numbers. This is so important because it takes all the emotion out of the decision. And he had a rule for it. To be a real bargain, Graham said its actual value should be at least 50% more than its price. This gives you what he famously called a margin of safety. This right here, this is the absolute holy grail for a value investor. Just think about it. It's like buying a business for less than the cash it has sitting in the bank after you pay off all its debts. You are literally getting the rest of the company, the factories, the brand name, all of it, for free. So, all of this leads us to Graham's most famous and maybe most powerful idea. It's a simple little mental trick that will completely change how you think about the market's crazy, wild mood swings. It's a simple little story, a parable, really, but it is the absolute key to keeping your cool when everyone else around you is losing theirs. See, this partner of yours, Mr. Market, he is, well, let's just say he's not very stable. He's manic depressive. Some days, he shows up at your door totally euphoric, offering to buy your shares for an insanely high price. But then other days, he's in a complete panic, terrified, and he's begging you to buy his shares for just pennies on the dollar. So the question is, should you let his crazy mood dictate how you feel about your business? I mean, of course not, right? You'd think he was a lunatic. And yet, this is exactly how most people react to the stock market. They let Mr. Market's daily mood swings become their mood swings. And this is the genius of it. You have zero obligation to trade with Mr. Market. You can just ignore his crazy offers altogether. Or, even better, you can use his moods to your advantage. You can buy from him when he's terrified and selling cheap, and maybe you can sell to him when he's euphoric and offering you a silly price. And that's the ultimate shift in your mindset. The market is not your master, it's your servant. You are the one in control. So the final question you have to ask yourself is, who's really running your financial future today? Is it you? Or is it that madman Mr. Market?